setup that we look to execute on and to stalk and to track, if you will, is based on time and price. And the time element is going to be related to the IPTA data ranges, last 60 days, 40 and 20. And we're going to be focusing on premium and discount PD arrays. So for short-term trading, we will excel in the range of the last 3 months. So the IPTA data range of 60 days is our look back period, and it's going to comprise every element that we need to frame a short-term trade, or one shot, one kill. Now, as a reminder, when we deal with time and price, price moves from a premium to a discount array, or from a discount array to a premium array. In between these two realms of premium and discount, price will key off of a time element related to the IPTA data range. So we're blending both time and price, an element of the last 20, 40, and 60 days, to a institutional reference point in the realm of the PD array matrix. Okay, for our study and case study examples, we're going to be looking at the cable, or British Pound USD. And this is a daily chart. And what we do is we define a market, whether it's trending or it's in consolidation. And obviously, anyone with the average intelligence in terms of market analysis, they can tell, looking at the British pound, we have been in a consolidation market. It's not been in a trending market, it's been in consolidation. So whenever we see a market that's range bound, or it's cannot move outside of the current trading range that you're looking at any given time on a daily chart, you're looking at a frame of about 3 months. Again, you're looking back 3 months or 60 trading days, which is the relative IPTA data range that we use for maximum definition of look back. So when we have this framework in terms of the last 60 days, what we do is we have to define the range in terms of a high and a low. Now what we do is we define the range in the form of its highest and lowest candlestick body. We're not concerned about the wicks so much, but we're primarily looking at the bodies of the candles. So I have here the lowest and the highest in terms of the candlestick's bodies, and you can see those reference points here with the arrows. And that's going to be our range that we're going to be framing all of our analysis concepts as it relates to one shot, one kill. Okay, so what we'll have to do is we have to look at the market in this range, and we can use a tool that's on every platform. It's the Fibonacci. So we're going to use our Fib tool to determine the 50% of the range, and we're going to note that range midpoint. So I'm dragging the Fib from the highest bodied candle to the lowest bodied candle. In other words, I'm not using the lowest wick low and the highest wick high. I'm looking for the highest body on the candles. Either it's an open or close. I don't care which one it is, but whatever highest form of high, open or close, that's the one I'm looking for in the last 60 trading days. And I'm looking for the lowest open or close in the last 60 trading days. That gives me my defined range in terms of consolidation. Then I note the 50% level, and I draw a horizontal line on my daily chart. Next, we have to determine the 50% levels of the upper and lower ranges. Anything above the 50% level, that's going to be our area at which we look for sell scenarios, either by taking profit on longs or short positions. And anything in the lower portion, we're looking for longs or covering short positions. Now the upper portion of the range, from the highest body, close or open, to the midpoint that we define by the total consolidation range, we measure that with the Fib as well. And I gave you 2 examples of where you could draw the anchor points with your Fib with the arrows. and you note the 50% level on your fib, and you drop a horizontal line there. By noting this, we've now noted the upper range for the total consolidation range. Next, we do the same thing by noting the 50% level of the lower range between the midpoint of the total consolidation range to the lowest bodied close or open, noting its 50% level as well on the fib. And I drop a horizontal line on that. Now, what we have here is by defining our consolidation range in this manner, it gives us a form of premium and discount identification. Anything above the midpoint or main 50% level, or in this case the gray, that would be deemed as a premium range, and anything below it would be deemed as a discount range. Next, we identify the PD arrays in each new range. Now I'm going to save us a lot of time and just apply everything from a monthly, a weekly, and daily. Okay, so now you can see all of the IPTA data ranges from a form of a premium and discount have been applied to the chart. Now I want you to look at this for a moment before we go to the next slide. So pause the video here and really study what's been identified. So every premium and discount array provides setups in the overall PD array matrix. So what we're looking for is an element of time and price to blend, a setup for a buy or a sell. We understand that the highest probability trades for shorts is by looking for any PD array in the premium range of this consolidation. So anything above the midpoint of the 50% level, or the gray level here, that's going to be ideal sell scenarios. If it is coupled with a PD array for a premium market, we are blending both time and price. We would look for that move to be correlated to a later discount PD array when price moves that down to either the 50% level of the total consolidation or any level below the midpoint or 50% level of the consolidation. An example would be the fair value gap and bearish order block in the premium level around the February time period of 2017 and pairing that with a weekly bullish order block mean threshold in the discount in March of 2017. Now, when we look at our quadrants like this, where it's been broken up into a premium and discount, we can also further define those quadrants into their own respective or unique premium and discount trading range. And what do I mean by that? Well, let's take a closer look. As you can see here, the lower quadrant can be divided into equal halves as well, and that in itself can be viewed from a premium and discount format. When we see these elements here, anything that forms as a discount PD array in a discount range from this view or perspective, this is going to be high probability short covering objectives, or it's going to be high probability new long positions. And any first profit would be best taken on a long once it enters the premium range of this PD array matrix. Again, moving up, the same thing can be applied to the new quadrants that's shown here. Ideal longs are entered at the discount level or in that discount range, and taking first profit would have to be best applied by taking your first long exit in the premium range of this PD array matrix. Now what you're looking at is a daily chart. So in the form of a 4-hour or 1 hour, you'll see that there's going to be premium PD arrays in those lower 4-hour and 1 hour time frames that you could pair up first objectives for targets. I'm giving you the elements to look at through the scope of a daily chart. And finally, we can apply it to this area as well. Each half is further divided into new halves, but we're looking at it in the form of an algorithmic way of defining premium and discount. So when markets are creating discounts like this, again, this discount range that's shown here, they're high probability longs, and again, a 4-hour or 1 hour premium PD array as defined here. You can't see them on the daily, but you would drop down into a lower time frame 4-hour and 1 hour to take first profit on your longs that you used to get entries on by buying in the discount area. Now we're above the midpoint of the total consolidation range. So now, even though we're above it and technically in a overall premium market, we can still take longs, but it has to be defined in the scope as we're showing here. We have the overall consolidation, we divide it in half, then we divide those halves into halves as well. So we have quadrants then. Those quadrants are divided in half as well, as we're showing here in incremental increases moving further up the overall consolidation range. By buying in the discount range and again taking first profit in a lower 4-hour or 1 hour premium range, coupled with a PD array that's premium based. In other words, if we were buying, for instance, the bullish order block mean threshold here in the discount. Now, overall, we're in a premium market, but this is still a possible long entry because we're in the lower portion of that total larger premium range. So we still have room to reach for higher premium PD arrays. In other words, we have range that we reach for much higher objectives. So looking at it like this, framing it, what would otherwise be deemed as overbought, we don't view it like that. This is why indicators do not work. From a algorithmic perspective, looking at price ranges like this, it gives us a greater definition on how we can frame entries and classify them as oversold or undervalued entries for longs, or overvalued or overbought entries for shorts. In this case, we could take an example of the daily bullish order block mean threshold. We could be buying there, and then once price trades up into the premium range, we could look for a 4-hour or 1 hour premium PD array to couple and exit with. And moving further up the consolidation range, we have a new discount and premium PD array matrix, and we could define this as well. And then what we're doing is we're coupling the range as defined by premium and discount with actual PD array in the form of fair value gaps, bearish order blocks, weekly rejection blocks, all those things to the left of our chart. We're looking back that 20, 40, and 60 trading days for the IPTA data range. So we're blending both time and price in the form of premium and discount. So we're blending the elements of time and price. We're looking at the market in the scope of overbought, oversold, but not in the context of an indicator. We're looking at it algorithmically in the scope of quadrants that are broken down into premium and discount. And by itself, it doesn't mean anything. But when price trades down to a PD array, whether it be a discount or a premium, if we trade into that element, whether it be a bullish order block, a breaker, any of those things from the PD array matrix that we've taught you, if you're looking for a long, the highest probable entries for longs, again, are entering in the discount range and coupling it with a premium range PD array. It doesn't matter that we're in a premium range of the overall consolidation. because price can move back and forth and oscillate from the highest portion and many times make a slightly higher high and return back inside of the range. And it can go to the lowest low, move outside the range a little bit, and come right back in the middle range as well. So we're anticipating the oscillation effect of price while it's in consolidation. But in that consolidation, there's smaller consolidations. So we're able to look at price in the view of overbought and oversold without the element of indicators or relying on mathematically derived number crunching lines. What we're looking for is range defined in the overall context of the consolidation as we've had here. We're in the upper half of the portion of the larger consolidation, and by itself that would many times filter out buy signals from anyone else that would look for overbought oversold. But for us, we can frame this with the oversold condition even in the element of a premium market. It's a discount market in a overall premium market that still has room to go up. That's basically, in other words, a layman's way of approaching a definition. But whatever we do in terms of entry or exits, we're looking for elements to frame the discount PD arrays. That means bullish order blocks, breakers, fair value gaps below us in price, trading below an old low to take out sell stops. We're using those ideas to frame long positions and then taking first profits at a 4-hour or 1-hour basis once it enters the premium PD array matrix range. And finally, at the top of the larger consolidation, we can see that there is still an opportunity where one could be a buyer, but the opportunities fall off precipitously in terms of probabilities. And you can see now that the premium array area, in other words, for PD array matrix, bearish order blocks, old highs, bearish breakers, bearish mitigation blocks, all those ideas, they're going to be much more influential in terms of price action, and you'll see much more dynamic price action from that side of the spectrum. And you can see that in the form of the weekly rejection block prices traded from in March of 2017. We saw also a move away from the fair value gap and bearish order block again, and it's largely hinged on the fact that we are in the upper portion of the overall consolidation, and we made it up into that last smallest portion of the premium market or premium PD array matrix. The shaded area that says premium, that's the highest portion or last little segment of price in this consolidation. So anytime price reaches up into that, it's going to have a much more impactful response in price when it trades to a bearish PD array or a premium PD array. So we see that happening with the weekly rejection block. It also took out an old high formed in February. So there's many instances there where you can see why price had a strong rejection. Also, keying off of that last midpoint that's dividing the premium and discount levels noted here, we had a really significant sell-off, and it trades all the way back down into a daily bullish order block mean threshold. Then we had a 100 pip move that we called for in our day-to-day meetings and charts, and you see the response. It trades right back up to what? The daily bearish order block, and it also overlaps with the premium 50% level. So there's a lot of things that you need to be able to look at conceptually, and you have to do it on your own time. I could give you a plethora of examples over and over and over again, but this is one teaching that I've given you enough that if you break your charts down and do your own study, yes, this is the part that requires your work. This takes study time. It takes you wanting to be in the charts, looking for it, because I'm not going to be there when we separate. You're going to have to do these things on your own. You have to find these opportunities on your own. But by having this element, what we're doing is we're looking for low resistance liquidity runs from one PD array to another, from a discount to a premium. But we're coupling it with looking back over the last 3 months, because one shot, one kill uses and excels inside the last 3 months of trading. So when we look back at the last 20, the last 40, and the last 60 trading days, it gives us framework to say, okay, where is the premium PD array matrix leading me to in terms of what I can sell to? and what I can reach for longs to couple my exits with, or where are my discount PD array matrix and where are those levels I can cover my shorts at. And I'm going to look back over the last 20, 40, and 60 days to pair those things up. I'm also now applying ranges in terms of the PD array matrix, whether it be a premium or discount market. So it allows me to build context of what I'm looking for as an entry and how I can look for my first objective in targeting. Now, in an ideal world, the best buys are going to be in the lower portion or lower half of the overall consolidation and in the lower quadrant, in other words, the discount matrix. And the highest probability trades for selling short or taking long exits are going to be in the premium range divided by the upper portion. So in other words, that last quadrant, that's going to be your best sells. The highest probability sells or highest probability exits for longs, that's going to be your best scenario. That's where the algorithm is going to reach for selling or exiting on longs. And any long position in here, again, you have to take it with a grain of salt. You have to know the overall range you're in, because just because you see it trading to a down candle, you have to understand that it has a room to go up. And in this case, you can see with the daily bullish order block mean threshold, that 100 pip rally was a response off of, yes, a PD array discount bullish order block, but it trades up to a daily bearish order block. But it trades up into that bearish order block. Once it gets into the premium range, that also gives us a high probability target. Now, yes, it's one shot, one kill scenario, and we're trying to trade the weekly range, but one shot, one kill is not defined by getting in on a Monday and getting out on a Friday. One shot, one kill is a couple days of trading. It's short-term trading. It can be as little as one day and as long as a week. And finally, when we look at the range in the middle, this can be the areas where you're going to get chopped up the most, because if you're looking at a range incorrectly, if you've already defined the range and you're looking at PD array of premium and discount that have already been traded to, in other words, if you look at a down candle in a discount market, normally that may be a bullish order block, but if it's already been traded to, the likelihood of it being a bullish order block with high probability falls off because it's already been used. We want to use a new PD array in a discount or premium market that has not been traded to, because the algorithm knows price has been there once before, so it's going to seek new liquidity and expand to allow the banks to take participation in a move higher or lower. So looking at the range like this, as we defined it, if you're trading in the middle of the range like this, and you're not strong in your directional bias or where the market may reach for next, in other words, understanding where open float is, where's the buy stops and the sell stops, if you're not really strong with that, if you're trading in this range here, you're going to get chopped up a lot. Over time, you'll learn how to better approach these specific premium discount ranges, but when you look at the outer rim, when we were just showing the previous slide, the higher you can get up in the overall consolidation in a premium market, the better your short positions are going to be, and the easier it's going to be to reach for a profitable discount PD array. The lower you are in the total consolidation, the better your discount long entries are going to be, and it's easier for you to get to a profitable premium PD array. Blending the two, time and price, working in a range environment like this, gives you context, and you can find very easy low resistance liquidity runs between one PD array to another, and understanding the element of time and price.